Welcome everyone to Vested Interest. This is Shane, and on this video we are going to cover the four stocks that I'm looking to buy in the month of July. We'll look at Procter & Gamble, Cisco, Comcast, and Union Pacific, as well as the two ETFs that I have been buying consistently every week in 2024 and will continue to do so. But before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. Now, for those of you who may be stopping by for the first time, on this channel, we focus on dividend growth investing. It's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, dollar cost averaging weekly into the portfolio, buying dividend growth stocks and growing companies with positive cash flow that covers the dividends, and companies with a high return on their invested capital. I utilize both a dollar cost average approach, consistently investing into the portfolio weekly. I also do a portfolio update every Sunday morning, so tune back in for that video as well. If I get a bonus or do a side job, I'll put that money into the portfolio as well. I try to dump as much money into the portfolio as I can. I do not have a paid Patreon account. There's nothing to pay for. I'm not trying to sell you any courses or anything. I cover all my investments into the portfolio out in the open. It's free to see what I'm doing. We all have enough to pay for. But if you would like to help the channel, if you could take a moment to hit that thumbs up button down below, make sure you are subscribed to the channel. Join us on this journey to financial freedom. Join the vested interest community. Make sure you hit that notification bell so you're notified whenever we put out any new content. Again, I do the portfolio updates every week on Sunday mornings. I also do a stock pick of the day series Monday through Thursdays. This series monthly, as well as a monthly series on the update for the portfolio, any dividends and options for the month. We do a recap of that as well. So make sure you hit all of those, the thumbs up, the subscribe, the notification bell. That really does help out a small YouTube channel like mine with the YouTube algorithm. It helps to spread the videos to more people. And one last thing you could do to help me out, if you could drop a comment, let me know what you are buying for the month of July. Are you buying any of the companies that I'm buying? Do we have any in that are similar, or do you have others that you'd like to share with the community? So first up on our list is the Procter & Gamble company, ticker PG, out of the consumer staples sector. Now all of these numbers will be as the close of business on Friday. Did close out the week at $164.92 per share, a market cap of $389.23 billion. So this is a large cap company here. Earnings per share of $6.12. Now the PE ratio on this one is a little elevated currently. It's $26.95 per share. Forward PE at a little lower than that, $23.45 per share. Now this one is about in line with the market as far as price to earnings ratio. This is an example of really paying, fairly value or fair value for a good company. So I'm all right paying a little higher premium than I would typically for a lot of other companies because of the nature of this company being a consumer staple, and as long as it's been around, continuing to pay the dividend, I'm more than comfortable paying fair price for this company. Now, I'd love for it to continue to pull back, and I'm not looking to add a significant amount to my position. This is one that I'll probably add one, maybe two shares a week over the next month, maybe for the next couple months if it stays down here below 165, though it looks like it tried to rebound a little bit in the after hours there. Now, it does have dividends, $4.03 per share. They are quarterly payers, divided by 4 there. Nice starting dividend yield of 2.44%. Ex-dividend date was April 18th. They paid out in May, so they're going to pay out again here in a couple months. Now, 52-week range, as low as $141.45, as high as $169.41. This is one that even the 52-week low is slightly above my cost basis. Another reason why I'm not worried about paying a little bit, closer to fair value on this one. My cost basis is so low. We'll see that here in a minute. That all I'm going to do is bring my cost basis up to in line with where it would sit at 15% of a 52-week low. Now, again, I'd love for this to continue to pull back. I'd like to get closer to this 141, 145 or even lower, and then I would add a significant more amount to my position. It does have a beta of 0.41, so it is less volatile than the overall market. Now, analysts call this one a consensus buy. They have a price target of $170.83, which would be a potential of a 3.58% increase. Again, this is a case of buying a company that's right around fair value. Earnings date is coming up July 26th, so tune back in if you are interested in earnings call. You can see here the drop off, about a 1.02% drop in the day trading on Friday. Let's jump over and look at the potential where it sits according to dividend yield theory. To do that, we look at the 5-year dividend yield average of 2.42%. We compare it to its current 2.44%. Actually, they're saying over here forward 2.42%. Again, that would make it right at fair value. Even at 2.44%, that would just be slightly over or slightly undervalued right there, 244 being higher than their 5-year average, but right in line with its 5-year average. So this one, again, this is a case of buying a company right around fair value. Payout ratio, I like 75% or less. This one's sitting at 61.48, so it gives them plenty of room to continue to raise this dividend, and they are growing their dividend over time. Return on equity on this one, I like 10% or better. They're at 31.3%. This tells you how well a company reinvests its funds back into itself. Again, I like 10% or better here, and same thing for return on invested capital. I like 10% or better, and they're at 18.24%. Very good numbers overall. Estimated EPS growth over the next 5 years, 7.91%. I look for 5% or better, so very good there. And revenue growth forecasted at 4.47% over the next 5 years as well. Let's jump over and look at free cash flow. We'll take a look at my position and wrap this one up and move on to number 2. Going back to 2021 here, you can see 15.584 in free cash flow, 2022 13.5, 2023 13.7, and the trailing 12 months, which includes part of 2023 and part of what they've already reported in 2024, is sitting at 16.1 billion here. So 15.5 billion, 13.5 billion, 13.7, and then trailing 12 months looks like it's going to be a year close to 2021 here at 16.1 billion, though we will not know exactly what it looks like until 2024 wraps up. I also like that they're repurchasing shares. You can see here very aggressively in 2021 to 11 billion, 10 billion in 2022, 7 billion in 2023. Looks like so far over the trailing 12 months, 3.4, but keep in mind, part of that is the purchase in 2023 as well. So we'll have to see what 2024 shakes out at the end of the year. I am long Procter & Gamble. I do have a position here. I own 34.113 shares. My cost basis, $140.32. So again, 52-week low of 141. I'm below where it sat at its 52-week low, so I would just be bringing my cost basis up to where it's in line with the 52-week low, or a little slightly over. But again, this is one I'd like to continue to pull back, but I'd like to add a little bit to this position and try to build this out to 50 shares over the next several months if it stays down here in the 165 or lower range. Obviously, the lower the better. I am up 17.53% on this position. So again, just want to add a little bit here at Procter & Gamble. Not going to go crazy unless it really pulls back, but am going to nibble here a little bit. Number 1. Number 2 on our list, Comcast. We have been adding to this position. This is out of the information technology sector. Comcast Corporation, ticker CMCSA, closed out the week at $39.16. Market cap of $153.28 billion, so another large cap company here. EPS sitting at $3.78 per share. Price to earnings ratio $10.36 per share. Forward PE even lower than that at $8.93 per share. Dividend is $1.24 paid out on the year. Another quarterly payer, so divide by 4. Nice starting dividend yield on this one, 3.17%. Ex-dividend date July 3rd. So coming up next week. So if you were to buy them before the July 3rd date, you want to buy July 2nd or sooner to make sure you're in line for the next dividend payout. This is actually one I'll probably get into the market on Monday and buy some more shares to catch this ex-dividend date. 52-week range as low as $36.43, as high as $47.46. So it is kind of floating in between the 52-week low, maybe a tad closer to the 52-week low than the 52-week high. A beta of 1, so it is just the same as the market, same volatility. Analysts call to buy, price target of $48.68 with a potential of 24.31% upside. So this is a case of buying an undervalued company with good fundamentals, in my opinion. Earnings date July 23rd. So again, another one coming up this month. No, we're not quite into July yet, but coming up in July. Let's take a look at dividend yield theory on this one as well. We look at their 5-year dividend yield average of 2.28%. We compare it to their current 3.17. Over here, they call it 3.24%. And the reason these are not exactly the same is some of this information, like the chart, is from stockanalysis.com. Some of the information is from Yahoo Finance. So this is one of the reasons I always recommend more than one source, so you can make sure the information is accurate and up to date. They have a little bit different numbers here, 3.17, 3.24. Either way, whichever one you use, speaks to undervaluation. Both of those numbers are well above the 5-year dividend yield average. So according to dividend yield theory, this one is potentially undervalued, and not only undervalued with a nice buffer in there as well. Payout ratio is very low on this one, 31.3%. And ex-dividend date is coming up again July 3rd. They are going to pay out in July 24th. So let's look how efficiently this company is reinvesting its capital. Again, I like 10% or better for these numbers. Return on equity at 18.6 is almost twice what I'm looking for there. Now, return on invested capital, a little lower, a hair lower than the 10% I'm looking for, but not so much that I would, throw this one out, throw the baby out with the bathwater, so to speak here. Now, EPS growth forecasted over the next 5 years is sitting at 10.82%, so twice the 5% I'm looking for there. Revenue forecasted growth is a little low at 2.03. Let's take a look at the free cash flow on this one. 2021, they're at 17 billion. 2022 looks like a drop down to 12.6. 2023, 12.9. Trailing 12 months, 13.7. So it looks like they might be creeping back up. But look here at the repurchase of capital stocks. Even though it looks like, 4.6 billion in 2021, looks like they might have dropped free cash flow in 2022. That's more than made up for in the increase in the repurchase of their shares. Same thing with 2023, 13 billion in 2022, 11.2 billion in 2023. Looks like they're continuing that trend into 2024, though again, we'll have to wait to see what 2024 numbers actually look like, because again, trailing 12 months includes 2023 and what's been reported in 2024. Now, all of these positions that I'm reviewing today, I have positions in, right? I'm long all of these, so I do have positions in Comcast, 136.775 shares. I am down 5.88%. My cost basis is $41.60. So this is a case where I'm going to be bringing down my cost basis, bringing up my dividend, dividend and my potential future return. So Comcast Corporation is number 2. Let's move on to number 3. Number 3 is Union Pacific Corporation, ticker UNP. This is out of the industrial sector. Closed out the week at $226.26 shares. Much like Procter & Gamble, this one is a little bit over my cost basis, so I'm not going to be looking to add a lot, but I feel like there is some value being shown right here, right now, even though it's over my cost basis, so I'm going to add a little bit here. Another one where it may be 1, maybe 2 shares. Now, if it was to pull back significantly, maybe I add a little bit more. But over the next couple months, I'm going to be looking to add, and specifically in the month of July, I'm going to be adding a little bit here. Again, maybe 1 to 2 shares a week on this company, as well as Procter & Gamble. Comcast, I may add a little bit more because it is below my cost basis. Now, a market cap of $138.05 billion, so another large cap company here. EPS sitting at $10.47 per share. Price to earnings ratio a little high on this one, 21.61, though the forward PE is lower at 19.30, so I do like that. Dividend is $5.20 paid out on the year. They are a quarterly payer, so divide by 4. Nice starting dividend yield of 2.3%. Ex-dividend date May 31st. Looks like they are going to pay, or they did pay out June 28th, so actually that would have been yesterday on Friday. I'll have to look at my brokerage account and see if those shares did indeed pay out. 52-week range as low as $199.33. Again, another one that my cost basis is well below its 52-week low, so I'll be bringing this up more in line with where it sits if its 52-week low. So that's another reason I'm looking to buy it. With my cost basis so low, I don't mind adding to it, even though it is over my cost basis. A beta of 1.06, so it is more volatile than the overall market. Analysts call it a consensus buy. They have a price target of $258.33 with a potential of 14.17% upside. Earnings date, another one coming out in July 25th here, so tune in next month for the earnings date. Let's look at dividend yield theory on this one. 5-year dividend yield average of 2.14%. Over here they call it 2.3, 2.33 here from Yahoo Finance. So either way, potentially undervalued according to dividend yield theory. Doesn't present much of a margin of safety here, but it does have a small margin of safety, and again, with a potential of 14.17% upside. Another one I'm comfortable adding to since my cost basis is so low. Payout ratio, again, very low. I like 75% or less. This is under 50% at 49.67, so a lot of room to continue to increase that dividend, pay down debt, repurchase shares, make acquisitions, reinvest back into the company. And let's see how well they are reinvesting back into the company. To do that, we look at return on equity and return on invested capital. Again, I like 10% or better for these numbers. Return on equity, 44.3%, smoking high. Return on invested capital, a little lower, 14.63%, but still over the 10% I'm looking for. EPS, double digits. I like 5% or better. They're sitting at 10.56. Revenue forecasted to grow about 5% over the next 5 years. 2021 free cash flow, you can see here, $6 billion. 2022, looks like a drop down to 5.7. 2023, 4.7. Trailing 12 months back to $5 billion. Though they are repurchasing their shares as well. $7.2 billion in 2021, 2022, $6.2, 2023 was a down year. There's no denying that. Their free cash flow was down and their repurchase of shares was down, but they're continuing it. It looks like they are going to continue that. Well, I don't know, because this repurchase of shares could be part of the $705 billion from 2023. So again, we will have to wait and see. The trailing 12 months includes, I don't like to typically use trailing 12 months, but we're well into 2024, so I decided we're going to go ahead and use it going forward. We'll just have to wait to see what the actual numbers for 2024 looks like and lean more heavily on 2021, 2022, and 2023 numbers. Now, Union Pacific, again, another one I own, 39.33 shares in. I am up 15.55%. So again, I will be increasing my cost basis, though my cost basis is very low, under where it sits at 15% of its 52-week low. So I don't even know that I'll bring it up into that. And then I'd really love this one to continue to pull back. So we'll see. But I'm going to add some, again, maybe 1-2 shares per week. This one was up slightly Friday at 1.25%. So that's number 3. Number 4, Cisco Systems, ticker CSCO. This is out of the information technology sector. Closed out the week at $47.51. Market cap of $191.41 billion. So another large cap company here. EPS sitting at $2.96 per share. Price to earnings ratio respectable at 16.05. Even lower forward PE at $13.49. Dividend of $1.60 paid out on the year. They are quarterly payers, so divide by 4. I think this one has the highest dividend yield of the 4 at 3.37%. Ex-dividend date was July 5th. They are going to pay out July 21st. So another one, if you were to go ahead and buy them on the 4th or before, so buy them next week if you want to get the next dividend. This is another one I'll probably add to this week so that I juice up my dividend a little bit. You got time for both this one, and was it Union Pacific there? Or no, Cisco and Comcast are the 2 that go ex-dividend next week. So if you want to get some more on the dividends there, you'll have to add before the 5th, and I believe it was before the 3rd on Comcast. 52-week range as low as $44.95, as high as $58.19. A beta of 0.85, so less volatile than the overall market. Now, analysts call this one a consensus buy with a price target of $55.97, potential of 17.81% upside. Earnings date is August 14th, so you got a couple months out for that. Let's look at dividend yield theory again. Current dividend yield theory, 3.37%, 3.37. These ones actually match up, 3.37%. 5-year dividend yield average of 3.04%. Again, another one according to dividend yield theory, potentially undervalued. And the way dividend yield theory works, if I haven't mentioned that, is you look at the 5-year dividend yield average, 3.04%. And since the current dividend yield is higher at 3.37%, that speaks to undervaluation. These numbers are inversely correlated. If this number was lower than their 5-year average, that would speak to overvaluation. Another one with a low payout ratio, 53.04%. I like 75% or under, so very, very safe here. Safe dividends. All of these companies right around 50% or lower in their payout ratios. Lots of room to continue to increase those dividends, and all these companies are. Cisco a little slower than the others. Well, I take that back. Union Pacific has not raised their dividend in the last couple of years. My hope is that they start raising that dividend again. So I'm going to add, but again, that's one that I am watching over the next year or two. If they don't start raising their dividend again and they hit year 3 or year 4 without a dividend raise, it may be one I look to trim out, and that's Union Pacific, not Cisco. Cisco is raising its dividend, although slow, right around 2 to 3% a year. Now let's look at return on equity and return on invested capital, see how well this company is reinvesting its capital back into itself. Return on equity sitting at 26.7%. Again, I like 10% or better. Return on invested capital at 15.04. So meets the metric I'm looking for there. EPS growth over 5% at 8.52%. Slow revenue growth at 2.94%, though it is projected to grow over the next 5 years. Looking at free cash flow, 2021 here you can see $14.7 billion, 2022 $12.7 billion, 2023 big jump up to $19 billion. Trailing 12 months so far at $12.4 billion. Now look at the repurchase of capital shares. Another one that's consistently reinvesting some of its capital into buying back its shares. 2021 at $3.5 billion. Big jump up in 2022. So even though it looks like their free cash flow went down, their increase in the repurchase of their capital shares went up. So that offset there is more than covered with this repurchase of capital shares. And I don't mind that. If free cash flow is going to go down, I want it to be used for something, whether that's making an acquisition, whether that's maybe a special dividend, or in this case, repurchasing its shares. So I would say that's not a decrease in free cash flow. That's more an increase in repurchase of capital shares. 2023, you had both very high free cash flow as well as some shares bought back at 14.89, and it looks like they're continuing that so far into 2024. Again, I do have a position here, and it's pretty well built out, but I'm going to continue to add to it. 211.384 shares. I am down 4.10%, so this is another case. My cost base is at $49.54, where I will be bringing down my cost basis, increasing my dividend yield, and increasing my potential future return. Now we'll quickly run through the two ETFs, and if you've been watching for any length of time this year, you know I am buying these weekly, one share at least. Sometimes I've been double dipping on SCHD whenever it's below my cost basis. It's not currently, it's right at my cost basis really, so if this one was to stay below my cost basis, it might be one where I continue to double dip. We are talking about Schwab's U.S. Dividend Equity ETF, ticker SCHD, Dividend Growth ETF here. Closed out the week at $77.76. You can see here, expense ratio very low at 0.06%. Whenever you're buying ETFs or index funds, you want to look for something with a very low expense ratio. Price to earnings ratio, $14.75. Dividend is $2.83 paid out in the year. Now, this is not as easy as just dividing by 4. It does fluctuate from quarter to quarter. So you'd need to see, and I believe they just announced their most recent quarterly payout, so you'd have to go tune back in for that. I believe it was the highest dividend they've announced so far, so very high dividend payout coming up. Dividend yield of 3.64%, very nice starting dividend yield. Payout ratio of 53.72%, one-year return of 8.73%. 52-week low, $66.67. 52-week high, $80.82. And I don't care about these. I'm going to buy regardless of what the price is. Whether it's at its high or whether it's at its low, I'm just going to be buying one share. It does have 103 holdings and inception date of October 20th, so it's been around since 2011. And here are the top 10 holdings. Home Depot makes up 4.12%, AbbVie at 4.12%, Cisco Systems. So you see I was adding to Cisco. It's in this one as well. At 4.06, Amgen at 4.05, Chevron 4.01, United Parcel Service 4%, Lockheed Martin 4%, the Coca-Cola Company 3.99, BlackRock 3.98, and Verizon Communications 3.95. That's the top 10, which makes up 40.29% of the total of the whole 103 holdings. SCHD, I do have 28.084 shares. I am up slightly, 0.12. My cost base is 77.67, right where it sits. So I'm surprised it says I'm up. These must be fractions of a penny or something. I'm surprised it says I'm up with the cost basis being exactly the same. But that's just the nature. Like I said, they must count out past the 2 digits that make up your cent. So it could be like 761555623, right? Something like that. Now, last on the list is the last ETF, weekly ETF. Again, doesn't matter what the market is. I'm going to be adding at least one share here, Vanguard Total Stock Market ETF, and that's exactly what it is. It's all of the companies in the United States stock market. Ticker VTI, $267.51 is where it closed out the week. Assets, $410.59 billion. Even lower expense ratio than SCHD at 0.03%. Very, very low expense ratio. PE, 25.16. So that tells you what the overall market is. 25, that is elevated. I mean, usually the market is down in the teens, 19, maybe touching 20, but this is a high PE. The overall market is pretty, I'll just say it's on the high side right now. Dividend $3.66. Again, divide by 4, though it's not that straightforward. They do fluctuate the dividend from quarter to quarter. Dividend yield 1.37%. Low dividend yield. You're really not buying this for the dividend yield, though it gives you a small one. You are buying it for owning the whole market, to help bring down some of that volatility in your portfolio, owning the whole market and looking for that, 7 to 8 to 10% return a year that the market typically gives. Payout ratio very low, 34.45%. 1 year to return, if you were to buy this, if you would have bought this right at the beginning of the year in a big lump, you'd have a 23.29% return. Right? I've been dollar cost averaging in it, so my return is not as high as that. 52-week low as low as $202.44, as high as $270.41. Again, I don't care where it's at, whether it's touching its 52-week low or it's at its 52-week high or setting a new 52-week low or setting a new 52-week high. I'm going to continue to buy at least one share a week going forward. A beta of 1.02, which is always funny because this is the market, so it's funny that it's slightly over the market, but that's what it is. 3,708 holdings. So again, pretty much every company in the United States stock market here, 3,708 of them. And here is the top 10. Microsoft makes up 6.06%, Apple at 5.54%, Nvidia at 5.12%, Amazon 3.24%, Meta 2.02%, Alphabet 2%, Alphabet. So you've got your Google shares, GOOG, and your Google shares, GOOGL. So GOOGL makes up 2%, GOOG makes up 1.65%, Berkshire Hathaway, Warren Buffett's company here, at 1.45%, Eli Lilly at 1.38%, and Broadcom rounds out the top 10 at 1.22%. These top 10 make up 29.69% of the total assets out of the whole 3,708 companies. I do have 26.039 shares. You'll notice that the share count here for VTI, even though I'm buying VTI and SCHD weekly, I have been double dipping on SCHD. That's why I have a couple more shares of SCHD than I do VTI. VTI 26.039 shares. I am up 5.46%. So again, you can see the difference. Had I bought all these shares at the beginning of the year, my return would be 23%. But because I'm dollar cost averaging weekly, it's only 5.46%, right? So it is what it is. I'm up, but again, I would love for this one and SCHD to pull way back, for the market to have a big drop. I know that's crazy to say, but so that I could get some of these cheaper again, bring down my cost basis, bring up my dividend yield, and bring up my potential future returns. Well, these are some others that I see a lot of. There is a lot of value in the market right now. Don't get me wrong. Even though the market is hitting all-time highs, it's really driven by just a few companies like Nvidia, Microsoft, Apple, several others out there that are really driving these highs, while a lot of other companies are pulling back and showing a lot of value. Pfizer, I still feel like, is showing some value. General Mills, Verizon, General Parts Company, Valet, Nutrient Solutions, Enbridge, Cisco, Havertys, Johnson & Johnson. There are others out there. I didn't put them all on this list, but there is a lot of value in the market right now, especially dividend growth paying companies. A lot of companies in the Dow showing a lot of value. A lot of tech companies are still flying high. But I believe those companies will be the ones that get hit the hardest whenever we do see a correction, which I believe is going to come sometime this year. I'm really looking forward to it. I actually have a big chunk of change set aside for both of my kids in their custodial accounts that I'm looking to buy this market a lot cheaper. Again, I may add to some of these companies as well. Cisco, I'd like to add a little bit more to. Havertys is very low. I'd like to add a little bit there. Johnson & Johnson, I may just nibble on this one. One share here, one share there. I'm also been running some options on Johnson & Johnson as well. Valet, same thing. I think I've been buying 1 or 2 shares of that every week as I have a little bit of extra cash left from my purchases for the week. Verizon, very high dividend yield here. General Mills, it's not in my portfolio. I am considering adding that. General Parts Company, same thing. These are 2 that I'm considering adding. If I was to make some changes like drop Kraft Heinz, General Mills would be where I'd rotate those funds. General Parts Company and a couple others, if I was to get out of Union Pacific, which I know I added it to my weekly buys, so I'm not looking to get out of it anytime soon. But if I was to add something, General Parts Companies in the industrial sector specifically, General Parts Companies is something that I'm looking for. Nutrient I have added a little bit to recently. Same thing with Verizon. Enbridge, very high dividend yield. Havertys, same thing, very high dividend yield out of the consumer discretionary sector. Looks like a lot of people are starting to think we're going to go into a recession, so a lot of these consumer discretionary companies are getting hit hard as well. A lot of value out in the market there. Several others I covered in the Stock Pick of the Day series. AGCO, AGCO is another one that I feel like might be showing some value right now as well. A lot of companies out there right now. Drop a comment down below. Let me know if it's not on this list, what other companies are you seeing value out there in the market right now? Well, that is really it for this one. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of dividend growth investors so we can share our experiences, what we're watching, what we're buying, how our portfolio is doing, and our investing journey is going. We cannot benefit from each other's investing portfolios, but we can certainly share our experiences and benefit from everyone's collective experiences and knowledge. And that is what this channel is about. So again, drop your comments, drop your opinions down in the comment section below. What are you watching? What are you buying? Where do you see value? What maybe are you selling that you're getting away from? What are you avoiding? I'd love to hear from you down in the comment section down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below. Make sure your notification bell is turned on as well, so you can be tuned in whenever we put out any new content. Tune back in on Sunday morning for our portfolio update so you can see what I bought this week, any options that we received, any dividends as well. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for tuning into me on this Saturday morning. Really appreciate it. And we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing for educational and entertainment purposes. Investing involves risk and money should never invest any amount in account losing. Always do your own research, invest based on your situation, circumstances, and select criteria, or seek the advice counsel certified financial advisor.